Hello, and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial Group. If you'd like more information about what you heard during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen. And while on my website, click on the podcast page to check out our past shows and to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. All right. For most Americans, tax advantage retirement accounts like 401ks and IRAs are a critical component of their retirement strategies. However, many people fail to plan for the fact that because of taxes, they won't be able to keep everything they've contributed to those accounts. So, when taking distributions from your retirement accounts, you'll often be required to include them on your income taxes. Thankfully, there are some simple ways to potentially reduce the amount of taxes you'll be hit with when you take withdrawals. So, a U.S. News and World Report article titled How to Pay Less Tax on Retirement Account Withdrawals provides a lot of information that I think will help us have an excellent and timely conversation today. But before we dive into our topic, let me introduce my co-host, Tony Shore, who spent all last weekend putting a plastic Santa, I believe, and reindeer on his roof. Hey, Tony, how we doing, buddy?
No, in fact, from the ground, I think, oh, that roof isn't that high. But my wife and kids tell me no more ladders for you,
Oh,
Dad.
yes.
I'm
That
I'm
might be
past the
smart.
ladder stage of my life, so I do put up lights. No Santa or reindeer on the roof anymore, but I do put up
Okay.
lights, and I did do that last weekend. It's the first year I've done it before Thanksgiving. It seems a little early, but Thanksgiving is late this year, right?
Yes. A lot of
So
people are doing that early.
yeah, because Thanksgiving's late and I wanted to beat the
Mhm.
cold and the weather, right? You know what I mean? In
Right,
case we get
right.
a snowstorm or something. So
Yes.
I do have all my Christmas lights up. How about you? Do you guys have your Christmas
Not
decorations up yet?
one iota yet. That is my job Friday, right after Thanksgiving. So,
Oh, okay. Yeah, that's when I usually do it.
yeah.
But yeah, so as far as this topic today, Albert, I think it's
Mhm.
a good one. I know some of our listeners may be able to save a few bucks on taxes, minimize that tax burden, especially on withdrawals during
Right.
retirement. And you got to plan ahead. The best time to figure all that out is before retirement and to
Mhm.
make sure you work with a financial professional, right?
Correct. Correct. In fact, the first smart action step is to, well, avoid an early withdrawal penalty. If you withdraw money from a traditional IRA before you're 59 and a half, you may be facing as much as a 10% early withdrawal penalty. But it may be possible to utilize penalty free 401k withdrawals when you turn 55 if you leave the job that's linked to that account. Additionally, you may position yourself to avoid IRA with early withdrawal penalties if you use the money you take out for approved reasons like, let's say, medical bills, college expenses, or even to purchase your first home, Tony.
Right. And, being sure that your strategy for retirement withdrawals is thorough, I think that's important. It's a great reason, again, to work closely with somebody like yourself, a financial services professional. And a few things make me sweat, like thinking about paying penalties on my own money, right? I mean, giving
Yes.
the government more than I have to.
Right. Well,
Yeah.
think about it. You may also be able to, let's say, roll your 401k over without tax withholdings. Here's how it works. If you, let's say you withdraw money from your 401k when you switch jobs, 20% may be withheld to pay your income taxes. Then, if you don't properly, let's say, deposit that entire distribution, including the 20% that was withheld, into a different retirement account, you may be left facing income taxes on top of the early withdrawal penalty. So,
Mm.
yet it's possible to avoid both the tax withholding and the potential penalties and fees if you transfer the assets directly from your 401k to the trustee of a different 401k or an IRA. Now, note that income taxes aren't withheld when you do it from trustee to trustee transfers, Tony.
Okay. So I have a question for you. How do required minimum distributions, or RMDs, as most people call
Mhm.
them, how do they fit into all of this?
I am glad you brought that up, Tony. Great question. As many of our listeners likely know, you're required to withdraw money from a traditional 401k and IRA once you hit your 73rd birthday. Now, the penalty for not taking an RMD is 25% of the total that you should have withdrawn. Now, that penalty is in addition to the income tax that you must pay on that withdrawal. But if you note your mistake and let's say take action to rectify it early, the penalty may drop to as low as 10%. Furthermore, if you're still on the job after you've hit 73 and you don't own more than 5% of the company you work for, you may be able to keep delaying the 401k withdrawals from your current employer, but not the IRA withdrawals until you officially retire. And then also note that the RMD age is scheduled to jump to 75 on January 1st, 2033.
Huh. Well, I guess that older RMD age, even if it's 8 years down the road, that's something that listeners will want to talk to somebody like yourself about. And it is good that they've been raising this because a lot of people want to leave that in there, let it grow, or, take taxes slowly as they go. So what's next?
Well, next, you should make sure you don't mistakenly take two distributions in the same year. See, your first RMD is required no later than April 1st in the year you turn 73. I should say later than April 1st of the following. Now, after that, your next and every subsequent distribution is required by December 31st each year. So, if you delay your initial distribution until April of the following year, you could end up taking two distributions in that same year. And that could mean a larger tax bill or possibly even moving into a higher tax bracket, Tony. Now, get together with your financial service professional. And I would say your tax professional would help as well to determine if your tax bill may be reduced if you take your first and second RMDs in different years.
Yeah, that makes sense. You don't want to push yourself into a higher tax bracket. And really,
Mhm.
this is all about minimizing your tax burden because, according to what you're saying here, Albert, what I hear you saying is that most people have traditional 401ks or 403bs or traditional IRAs, and
Mhm.
those you owe taxes on all the money you take out. So, but a lot of people, they make you start taking it out. But don't you think some people might want to start taking money out earlier, a little at a time to spread that tax burden out?
Bingo, you are absolutely right, Tony. We utilize a lot of this strategy and working them to spend down those tax monies first in retirement. And
Sure.
while you aren't required to take, let's say, money out of your traditional retirement account until you do turn 73, taking smaller distributions while you're still in, let's say, your 60s could help you spread the taxes you owe over more years while also buffering you in a lower tax bracket. And that could ultimately mean you lower your lifetime tax burden. Now, taking 401k and IRA withdrawals when you, let's say, have a lower income year, perhaps, for example, after you've retired but haven't yet begun, let's say, collecting Social Security, could mean you'll face even a lower income tax bracket on your retirement savings. For
Hmm.
example, let's say a meeting with your financial services professional may determine how much you can withdraw from your retirement accounts annually to stay within your current tax bracket or perhaps even move into a lower tax bracket, Tony.
Right. Well, we should probably take a moment here, Albert, to let our listeners know how they can get a hold of you. I know you set aside a few time slots for a no charge, no obligation consultation, or if they have questions about this topic.
Yes, listeners, you can visit my website at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen, or call my office at 586-752-7008 and discuss how we can answer your questions about retirement taxes, your retirement goals, or any other elements of your financial strategy. Remember, it's our goal to help you prepare for the retirement you've worked so hard for.
Yeah, definitely. And during today's show, you've been talking about how we might be able to save some money on our retirement withdrawals or minimize that tax burden, maximize what we get to keep. What do you have for us next?
Well, let's stick with that U.S. News and World Report article, How to Pay Less Tax on Retirement Account Withdrawals. It has some more information I think that was going to help in our conversation today, and that's dedicating an IRA distribution, let's say, to a preferred charity. Now, this is an option you may want to discuss with your financial services professional and tax professional. Now, those who are at least 70 and a half may be able to avoid paying income taxes on IRA withdrawals of up to $100,000 or $200,000 for couples annually if they contribute that money to a charity. Now, a qualifying charity donation must be paid directly from your IRA to the qualified charity. Now, you aren't required to, let's say, itemize your taxes to make an IRA charitable distribution. And you're allowed to donate, let's say, to multiple charities. But an IRA charitable donation meets the minimum distribution requirement. You're also permitted to earmark, let's say, a percentage of your RMD to charity and then withdraw the remaining amount as income for yourself. I also suggest discussing these strategies, though, in greater detail with your financial service professional and your tax professional.
Right. Yeah, that's really important, and I'm glad you brought that up. And on previous shows, you've talked about how many of your clients have
Mhm.
charities and organizations, churches that they support. So, talking about that option in greater detail with you is really important because if you're tithing regularly to your church or giving to
Right.
charities, you might as well not have to pay tax on that money that you're contributing, right?
Well, that's just it. If you're doing tithings on non-qualified money, you may want to rethink that and start doing it with the qualified account so you can fulfill your RMDs and
Yep.
still do good for the community. So it's
Yeah, there
really
you
nice.
go.
Okay. Now let's move forward on some of the retirement assets, let's say into an after tax Roth account. That may help position you for more of a tax free investment growth and tax free withdrawals during your retirement. And now, while you won't be able to utilize, let's say, a tax deduction in the year you contribute to a Roth IRA or, let's say, a Roth 401k, you won't be required, though, to pay income taxes on the growth within the account and withdrawals during your retirement from an account that, well, that's a minimum 5 years old, and they are generally tax free. Now, if there's a possibility that you'll find yourself, let's say, in a higher tax bracket during retirement, a Roth account may position you to stay at your current lower tax rate.
Yeah. Well, and but as you've explained on previous shows, Roths aren't going to be the right move for everyone, right?
That is right, Tony. In fact, though Roth IRAs and 401ks do come with, let's say, certain advantages, they don't fit inside every financial strategy. In fact, in my opinion, the largest possible risk is that when you put money into a Roth account, whether it's a Roth 401k or a Roth IRA, you're anticipating that you'll be in a higher tax bracket once you retire. But what if you aren't? Well, you should certainly prioritize paying taxes on your money when your tax rate is at its lowest. For example, if you're currently in a 22% tax bracket, but it's beginning to look like you'll be in the 12% tax bracket during retirement, well, you're not saving nearly as much money. There are also other possible disadvantages that, well, you should address with your financial service professional before you make any final decisions.
Sure. Well, and these are great details. Don't make any permanent decisions about a Roth IRA or 401k before getting together with somebody like yourself. That's the bottom line, right?
Big key right there,
Yeah.
definitely. Now let's talk about moving some tax preferred investments to something outside your retirement account. That's another potential option when it comes to saving money on your retirement withdrawals. See, investments that generate, let's say, long term capital gains are entitled to a special tax treatment when they're maintained outside an investment account. However, if you put those assets, let's say, into a retirement account, well, you'll pay your standard income tax on the money you withdraw from those accounts. Conversely, you may be able to slash your tax payments a bit by maintaining more highly taxed investments, such as, let's say, Treasury inflation protected securities, corporate and government bonds, and funds that provide short term capital gains within your retirement accounts. Now, let me know here that I avoid getting too into the weeds about investing basically on our shows because we don't have ample time to really get into, let's say, all the rules and regulations that investing comes with. But I will say, however, that if investing is part of your broader financial strategy, I'd strongly recommend that you work with the financial services professional, Tony.
Oh, yeah, for sure. Tell us more about the charitable donations that you mentioned earlier. I think that's an important topic that we should revisit.
Definitely, Tony. And let me add that it's possible that it's a possible solution that generally doesn't get the publicity it deserves. So let's take a look at another U.S. News and World Report article titled "How to Donate to Charity from Your IRA." Let's start with the short review. A qualified charitable distribution is an IRA withdrawal that's paid directly from your IRA to your chosen qualified charity. So, step one is to ensure you met the qualified charitable distribution requirements. You must be at least 70 and a half to make a tax-free charitable contributions. Those who meet that requirement are permitted to transfer as much as $100,000 annually from an IRA to a qualified charity without paying income taxes on that transaction. Be aware, though, that if you file a joint tax return, your spouse is permitted to contribute as much as $100,000, which means a married couple can exclude as much as $200,000 on the retirement savings from their income taxes if they donate that money to a qualified charity. Now, if you contribute more than the maximum amount that's allowed, it will be considered as income and will be subject to the income taxes. Qualified charitable distributions are required by December 31st every year for that amount to be subtracted from your taxable income.
Right. I think that's great. And, this is really an important topic. And we're talking about how to make qualified charitable distributions. And if you're not familiar with those, we're going to describe that a little bit more. Tell us more about that now. Let's keep going with this one, don't you think?
Yeah, it's a great idea. Let's keep going on with that U.S. News and World Report article, How to
Yeah.
Donate to Charity from Your IRA. The next thing to consider is that a qualified IRA charitable contribution meets the minimum distribution requirement from your IRA. Additionally, you may earmark part of your required minimum distribution to charity and then withdraw the remaining funds as retirement account if you meet the minimum distribution requirement before the end of the year. Now, if you've already, let's say if you're already contributing annual donations to the charities and organizations you share your values, why not make those donations right out of your IRA with money you're required to take out anyways? And also remember, this only applies to your IRAs, does not apply to your 401ks and 403bs. Okay. You cannot make a direct a charitable contribution from those type of accounts. Okay.
Yep. Yep. Sounds good. And, that strikes me as a solid idea. I mean, obviously, if you're already donating to your cause or organization, there's not much downside to doing it in a way that's going to provide you with a tax advantage because it's a win-win. Your
Right.
charity or organization still gets that tax-free, and then you don't pay taxes on the money you're donating. So it's
Correct.
kind of a no-brainer, right?
Yeah, it definitely is.
Yeah.
And, figuring out your qualified charitable distribution tax break, well, it's another big factor you should be familiarized yourself with. And as the article notes, a $100,000 charitable contribution from your IRA could end up saving you tens of thousands of dollars in taxes, depending on your tax rate. But it's also important to know that you don't have to make a sizable donation to benefit from this specific tax break. So let's take a look at example. Let's say if you're in the 24% tax bracket and make, let's say, a $5,000 charitable donation, you may be able to reduce your tax burden by $1,200. And a $1,000 donation could still save you $240 on your taxes in the year you make the contribution. So the potential tax benefits of charitable contributions from an IRA are even larger if you're in a higher tax bracket.
Um, Yeah, well, and building regular charitable donations into your financial strategy. Again, I wouldn't want to do that without working with somebody like yourself. This doesn't sound like something we should be doing on our own, right?
No, you shouldn't. You should work with the financial service professional. But more importantly, there's ways that you can set this up automatically. Moving on, you may want to set up a direct transfer to your preferred charity or organization. This is another piece of your strategy that your financial services professional would be able to assist you with. In fact, to qualify for this tax benefit, your assets must be moved directly, like I said before, from your IRA to a qualified charity by the IRA's trustee. If you take money out of your IRA and later elect to donate it, it won't qualify as a tax-free qualified charitable donation. As with so many other elements, though, of your financial strategies, it all comes down to timing, Tony.
Yeah. Yep. No problem. No problem. So, I really appreciate all of this advice. This is a great point, and I think it's so important. You have to ensure your distribution is directly payable to your chosen charity or organization for that
Yes.
money to be claimable as your qualified charitable distribution, right?
Definitely. And make sure
Yeah.
you know if your charity qualifies. When it comes to selecting your qualified charity, it must be a 501c3 organization for it to be permitted to accept your tax free IRA charitable contributions. So basically, Tony, you can't give it to me as a charity. I'd love it, but it won't count for you. Okay. And then organizations that don't qualify include private foundations and donor advised funds. Now, you may also distribute your requirement minimum distributions to more than one charity within the same calendar year. For example, you may want to consider dedicating a portion of your donation to an organization in your community that provides food assistance, and then maybe another portion to your donation to arts focused organizations that provide services you enjoy.
Right. Well, and that's so important to so many people. I know my parents made that. I saw them make this exact mistake, Albert, because
Mm.
they would cut a check to the church twice a year for
Yes.
their tithing. They tithe to their church and a big amount too. And they'd write a check right out of their bank account, and that's money that they paid taxes on. And
Yes.
they were over 70 at the time. And so they could have done it this way and
Yes.
saved that money, right?
Definitely. They just didn't know any better.
Yeah.
Is what
So,
it's like.
what are some of the key steps with this process we should know?
Well, first, you must meet qualified charitable donation requirements. From there, you must also meet required minimum distributions and then determine your qualified donation tax break, complete the steps for direct transfers, and then choose a qualifying charity.
Right. Yeah, that's true. That's a good point. Can you make charitable distributions from employer plans then?
Ah, qualified charitable donations can't come from employer plans. Now, a current simplified employee pension plan or even simple IRAs. Those who are interested in making qualified charitable donations from the 401k or other employer plan will need to work with their financial service professional to determine other options. Now, you may be able to, let's say, create something of a workaround by asking your financial service professional to do a direct rollover from your employer plan to an IRA, or let's say a transfer from an active simplified employee pension plan or a simple IRA to an IRA. Completing that step, a qualified charitable donation is now permissible from the IRA.
Yeah. Yeah. Um, are there situations when a qualified charitable donation may not be the best strategy?
Well, as with many other components of your financial strategy, a qualified charitable donation may be a good option for some people and the entirely wrong move for others. In fact, a article from Fidelity Charitable titled "What is a Qualified Charitable Distribution?" it describes some of the possible drawbacks. One, if you own securities that have become more valuable through the years, it may be advantageous, at least when it comes to getting a solid tax benefit, to donate money from them directly to your chosen charity rather than making a qualified charitable donation. Moreover, if let's say you prefer to take a tax deduction in the current calendar year and then support your preferred charitable organization in the future, a qualified charitable donation may not be the prudent step. And then finally, if you're considering, let's say, a significant charitable donation, working with both your financial service professional and your tax professional may lessen your tax liability and improve the overall impact of your gift.
Yeah. Yeah. That's a big one. That's really big. And again, I wouldn't want to do anything. This all sounds like it can get complicated.
It
So,
can.
well, Albert, this has been a great show. We're out of time for today's show. Do you have anything else you want to add before we go?
Listeners, if you can visit my website at www.kaizenfinancialgroup.com. That's Kaizen again, Kaizen, or call my office at 586-752-7008. Discuss how we can answer your questions about all the retirement taxes, your retirement goals, or any other element of your financial strategy. Remember, it is our goal to help you prepare for the retirement you've worked so hard for so that you can own your retirement.
Yep, there you go. Well, I think that's fantastic. And that concludes another episode of Own Your Retirement with our host, Albert Lalonde.
Take care, everybody.